Hello friends, now let's try to understand the history and evolution of risk management. So is risk management a 21st century phenomena? Did risk management evolve only after global financial crisis of 2008? What is the history of risk management and how the key concepts behind risk management as we understand it today evolve over a period of time? Risk management is not new to human beings. When we were hunter-gatherers, we were storing meat for us to feed when we couldn't hunt, for example during rains or during winters. Then when humans started getting into agriculture, we'll produce the crop and store it for consumption when we didn't have the crop. Likewise, a good general in a war always used to keep some army in reserve to attack the enemy when the enemy was tired. So risk management is not something new. But when it comes to the financial domain, the recorded history of risk management we can trace back to last few centuries. One of the earliest recorded concepts backing risk management is the theory of probability. It is attributable to two French mathematicians, Pascal and Fermat, who developed it around mid of 1600s. So Pascal was looking for game theory and to use it, and during that he gambled upon the other problems, including the one around the chances, occurrence and the probability. So just like the penicillin was discovered by accident, probably we can say the theory of probability that Pascal and Fermat discovered was the result of an accident while they were working on something else. And as we know, probability theory is very fundamental to risk management. It is about occurrence of events and what are the chances of occurrence. Then in the 18th century, the beginning of the century around 1703, Swiss scientist Jacob Bernoulli, whose name we must be knowing very well, invented the law of large numbers, which became persecutor to the latter theory of statistics. So what exactly is law of large numbers? If we take observations that are sufficiently large in numbers, let's say the population of Maharashtra or population of India, and let's say we calculate the weight of the people and then we distribute it according to the frequency. Let's say people within the range of let's say 0 kg to 5 kg, 5 to 10 kg and so on and so forth. Then as per the law of large numbers, we will get a standard normal distribution. The numbers will be spread in a particular way. The frequencies of the numbers will represent a certain kind of a distribution pattern, and this is basically the law of large numbers. Now this law of large numbers later gave around 1730 to what is we are calling as the bell curve, which fits a certain pattern, and also the concept of a standard deviation, which is used to measure the risk. Now as an example, law of large numbers is something on which the entire concept of insurance is based. If the insurance company doesn't have the insured in sufficiently large numbers, there might be events which will make the insurance company bankrupt, because their entire theory is based on having let's say 1 lakh or 2 lakhs or 5 lakhs motor insurance policies, so that their estimation that we'll have to pay let's say 1.5% claims within for 6 months comes true. Likewise, the standard deviation as a concept is very widely used in finance and specifically for measurement of risk. Standard deviation is fundamentally considered as a measurement of risk. For example, when we look at let's say risk versus reward relationship, we have risk on one axis, x-axis, and then we have the reward or the return on the y-axis. And as the risk increases, the reward, the potential reward is expected to be more. So this risk there is measured by something called standard deviation. Then in the 19th century, Francis Galton developed the statistical concept of regression to mean. Now what does regression to mean means? That there is a tendency for returns or any kind of sort of variations in the finance to return to normal. What is return to normal? Let's say over last 10 years, certain classes, asset class has given a return of let's say 12% compounded average growth. Now you can expect that over next 1 year, other things being equal, there being no major economic factors or changes, then the returns that the portfolio will yield over that next 1 year period will yield a mean of approximately 12%. This is basically returning back to the normal. Then in the 20th century, Harry Markowitz demonstrated mathematically why diversification is the key to investment risk reduction and long-term performance of the portfolio. So if you combine multiple assets, what you do is, because of the covariance between various assets within that portfolio, the risk can be reduced and at the same time the returns can be maintained or increased. So this is something which is called the modern portfolio theory. So the entire theory of the asset management or the portfolio management is built upon this Markowitz theory of basically investment reduction and long-term investment performance. So using this theory, we can build something called efficient frontier of investment. For example, there is a trade-off between risk and return. So how we can efficiently maximize the returns given the certain level of acceptable risk. And many financial tools have been developed based on this diversification as a basis of risk management. Then again, in the 20th century, one of the key inventions that came in the world of finance was the Black and Scholes model around pricing of the options. So in 1973, Fisher Black and Myron Scholes developed an option pricing model at University of Chicago. And this takes into account some of the factors like the risk-free interest rate, the volatility in the price of the assets, etc. to arrive at the right or the fair value of the option or the options contract. Later, Merton and Scholes were given the Nobel Prize for this because by that time, unfortunately, Fisher Black had passed away. So this is one of the key concepts in finance, again, option pricing. Apart from Black and Scholes, of course, binomial options pricing formula is also very, very popular in pricing of the options. So understanding some of these key concepts like standard deviation, bell curve, return to the mean, these will help you in terms of doing a good career in risk management, because understand one thing, if you want to be good at risk management, you must be good at numbers, you must be good at these mathematical concepts. This will help you identify whether the risk management rules are right for you and then what skills you need in order to get a great career in risk management. I hope you found this video useful. If yes, please do like this video, share with your friends and also subscribe to my channel. Thank you very much. Take care and cheers.